I am revealing that I finally bought into Rowe Price. This has been on my watch list for over a year now, and due to the price going down drastically and the fundamentals of this company, I finally decided to buy in. I had a small portion of my allocation to financials in my portfolio, so I wanted to increase that by adding another stock, and that's Rowe Price. I also have Bank of America, a small position, but to me, Bank of America is overvalued right now, and so I can't buy into it at levels like this with a small dividend. That's just me. So Rowe Price is one that I went into. Now, before I get started, a few of you mentioned that there is some issues with the volume. So if you can let me know if the video today is better, if you can hear me well, I'd really appreciate it. Also, if you're new to the channel, feel free to subscribe. I provide a lot of content, both financially and on the fitness side, and it's diverse, it's of quality. I'm transparent about my portfolio, so you get to follow along and see my strategies and how they do long term. So today we're going to talk about Rowe Price. We're going to talk about the fundamentals, a lot of things about it, and then why I decided to buy in. So we're going to start off with Rowe Price and basically what it is, its profile. And so Rowe Price, they are essentially a publicly owned investment manager. The firm provides its services to individuals, institutional investors, retirement plans, financial intermediaries, and institutions. It launches and manages equity and fixed income mutual funds. The firm invests in the public equity and fixed income markets across the globe. So I went to their website to really see specifically what investments they offer, and it's really mutual funds, separately managed accounts, ETFs, which is new to this company, so that's exciting, collective investment trusts, and retirement and target date solutions. We know how popular those target dates are with people that work for large corporations and just want to set it and forget it type of deal. If we look at their chart, a one-year chart, they're down almost 20%. That's pretty massive, in my opinion, from a year. Usually you want to buy into something and it appreciates year over year, it grows. This is down 20%, which is part of the reason why I decided to buy in. But mainly, this stock is down because of the fears of a recession or a market crash. And later on in my video, we'll kind of dive a little bit more into this to kind of also have some more details on why this stock is down. But one of the things I do like about this company, it has low to virtually no debt. If we look at its debt to assets, it's only 18%. That is extremely low. Now, I've done some research on this company, and there's a lot of areas where it says it's debt-free. And then there's some that says it has minimal debt. So who knows truly, but regardless, it's very low debt, if anything. If we look at their debt, they have no debt in current liabilities and long-term debt of only $249 million as of last quarter. But keep in mind, I will show this in a little bit, their cash is much, much higher than this, and that debt to assets is only 18%. So to me, the low debt or the no debt is great for this company to be able to pivot if needed on something that it deems really attractive. So let's look at Rowe's earnings. So if we look at their last earnings, we're going to go over these and then go into detail on some of them. But their revenue is up 13.2% year over year. That's an excellent, awesome number. Their net income is down 5.46%. So that to me, I don't like to see net income decrease. But the fact that their revenue increased so much and their net income went down, there's a reason for that we'll see here in a little bit. And if we look at their operating income, it's up 18.32%. And then you see that number at the bottom, and it might scare you, but I will explain that. Their net change in cash is down over 3,600%, which if you are somebody that just looks at things for face value, this would cause you to stay out of this stock. But I'm going to explain why this cash went down and why it's actually a good thing and actually makes me more bullish on this company and made me buy in as well. So if we look specifically at their revenue growth, I think it grew about 24% last quarter, but year over year, the revenue is growing. This is what you want to see in a company. This means it's being managed very well and it's finding ways to become more and more profitable. So that is something that's extremely awesome. As far as their products that they offer, kind of the different asset classes, their assets under management, they are increasing the diversity. You'll see from 2014, they only offered equity and fixed income, but now they're offering also multi-asset and alternatives. And so to me, this is awesome because you never want to be concentrated in just one area or just two, and they are increasing their diversity. Again, it's a movement towards the positive. Now, TROW's assets under management has increased 14.8% year over year to 1.69 trillion. This is their bread and butter. And the fact that their assets under management grew by 14.8%, that's a very healthy number and is what's really probably helping that revenue number that we just saw grow so much as well. So that's something I really like to see. Now their assets under management, the distribution of it is 38% in U.S. retirement plan sponsors, 20% in global financial intermediaries, 19% in global institutions, and 23% in individual U.S. investors. So it shows you just more diversity amongst the assets under management, which I like to see. And it's something that just provides me a little bit more bullishness on this company because it's not highly concentrated in just one or the other. This pie looks pretty even. Now, I said their debt was, no debt to virtually none, but it does show 249 million. So what about the cash? Well, as we can see here, their cash over the quarters is well above $1 billion. It's ranged from the 1.6 up to 3.5 billion. Now this one quarter, you did see that drop off from 3.5 billion to 1.6 billion, but there's a reason for that. So Rowe Price actually just acquired the investment firm Oak Hill Advisors for approximately $4.2 billion, and a lot of that hit that cash. So Rowe Price said this should be a one-time thing, not to worry, and I actually like this move because Oak Hill Advisors specializes in high-yield bonds, leverage loans, distressed securities, and turnaround investments, and brought $56 billion in asset under management and a diverse customer base to the table. So this is a company that is making moves to diversify even more and put itself in a position to become very profitable in the future with this acquisition move. And so that's something that this did happen. It did solidify on December 29th of 2021, which that's their last quarter report. So that's why the cash is down. But as I said again, Rowe Price said this should be a one-time thing. Speaking of, something that really attracts people to this stock, that's their dividend. Now, they pay an extremely attractive dividend at 3.36%, which is well above the market median, and their payout ratio is a very healthy and small 37%. So that just means that their dividend is very safe, and that's what I like to see because I don't want to risk investing in a company, especially when a lot of investors do it for the dividend, and there might be a risk in the future of that being cut or stopped. Now, I also did some research, and they do put out special dividends every once in a while. In February of 2015, they issued a special dividend of $2 per share, and just as soon as June of 2021, just last year, they issued $3 per share. So that's just a nice surprise as an investor when they do announce those special dividends. So that's something I look forward to someday getting with TROW. As I stated, they are now offering ETFs, exchange traded funds. This is something that they are a little late to the game, but at least they're in it now because this is something that just keeps on growing in popularity. It offers a lot of safety and diversity, and it's there's basically an ETF for everything. And so the convenience of ETFs are where I think people are going to continue to put their money. It will continue to grow. So I'm glad they finally started to offer this service. So with all this going, in summary, basically, they're a well-managed and highly profitable asset manager with a great balance sheet. We saw the very healthy cash compared to the debt, and that decrease in cash was due to that acquisition. So it's explained, and management said it's a one-time thing. One of the things that's a little bit more of a risk is 90% of the revenue is from advisory fees. And, that just means that the profits are going to be tied directly to what the economy and the stock market does. If they don't do well, TROW won't do as well. So if it does very well, then TROW does well. So that's something you have to keep in mind. And at the end of 2021, they had 1.69 trillion assets under management. Advisory fees. One thing to justify that is they have to outperform their peers, right? To justify charging the fees. And with T. Rowe Price, this is where they are shining as well. So at the end of 2021, 62% of the funds outperformed their peers over the last 10 years. That is something that when they're going out to market to, say, hey, come with us, 62% of our funds outperform our peers. That's going to get them more business, more customers, and it's just something that solidifies what they charge. And so investing in T. Rowe, you have to keep that in mind. You have to keep on top of that to see, are they continuously outperforming their peers to, justify those fees? Because when somebody decides to go with them, they want to make sure that they're investing in with a quality company and paying these fees that are going to be beneficial. They're going to be outperforming instead of going with somebody else. Again, they have just strong cash generation and virtually no debt. They also do share buybacks. So their diluted shares outstanding decreased on an average of 2.2% each year. So that's just making you and I as an investor own more and more of T. Rowe Price, which is a great thing. And to put the cherry on top, they have a 10.4 PE ratio, which is below a lot of their peers and below the industry as well. And so with T. Rowe Price, I saw a beaten down stock due to all this, the fears in the market. I saw a very attractive buying opportunity. I bought under $140 per share, just shy of 140, and I will keep adding because I don't think that this economy, the height of the fears is quite over yet. So I will keep adding to T. Rowe until I feel things bounce up, because as I stated, when the market isn't doing well in the economy, neither is T. Rowe. Those are the times to buy in a company like this. And then when things turn around, that's when I'll let it just kind of ride until the next time that we have some type of adverse situation that affects the market. So if T. Rowe is something that you're looking into, now's the time to buy in my opinion, and I will keep putting money in until it probably goes above 150. I also love the dividend of 3.3% and that it pays special dividends. That's just a bonus for us, investors. Plus, we looked at all the fundamentals, the financials. This company is doing very well. It's well positioned to keep on growing. The revenue looks awesome. And so this is one that I wanted to add to my portfolio to further diversify my financial sector. And I'm very excited about this. And let me know if this is a company that you are invested in and what you think about it. Is there, do you not like them, or do you like them enough that you either already have them or you do want to add them? I think T. Rowe has been popular these last couple months, especially with the market going down. You saw their stock is almost 20% below what it was a year ago. And so this is getting people to talk. So I wanted to not only make this video for that reason, but I also bought into the stock, so I wanted to share it and do my initial analysis of it. And for me, this is a strong buy in my opinion, but keep in mind there's still some market volatility ahead in that could really make this stock go even further down. So I wouldn't dump all your money into this. I would just decide what portion of money you want to put into T. Rowe and maybe average in every week or couple weeks to capture any dips that could happen. So that's what I'll be doing. And I'm not going to add to my Bank of America, as I stated, because I just think it's overvalued. I do have a financial sector ETF, but I don't have much money in that. So T. Rowe is one that, it's an investment management company. Bank of America is a bank. So it's diversifying my financial sector as well as adding just the financial allocation to my portfolio, and it's going to be nice to earn those dividends. So let me know what you guys think. I appreciate you guys viewing this. Again, feel free to subscribe to my channel if you're new, and I appreciate all you guys out there viewing this. And let me know if the audio issues are better or fixed, or if you need it to be even louder, and I appreciate that feedback. Have a great day. We'll see you next time on Mark's Finance and Fitness.